This macro dashboard displays the global trading data for the morning of May 1st, 2026. What you are looking at is a matrix of severe financial contradictions. In the Middle East, a formal United States Navy blockade of the Strait of Hormuz has sent oil surging past $110 a barrel. Yet despite an active kinetic war and a massive energy shock, United States equities are printing fresh all-time highs. Simultaneously, gold, historically the ultimate safe haven asset during geopolitical conflicts, is actively plunging to a one-month low. And across the Asia-Pacific region, over half of the major financial markets are completely offline, in observance of May Day and Golden Week holidays, trapping substantial institutional liquidity. Why are institutional investors aggressively buying risk assets and dumping traditional safe havens in the middle of an escalating war? The current market reflects the tension between regional geopolitical instability and a specific shift in how central banks manage the cost of money. Navigating this session requires looking at the regional holiday schedule, the internal mechanics of technology valuations, and laws governing real interest rates. Right now, major financial hubs across mainland China, Hong Kong, and India are synchronized in their closure. Because of the holidays, the stock connect data lines between Hong Kong and mainland China are mechanically suspended. Foreign institutional capital, typically using Hong Kong to access Chinese equities, is redirected into the only open deep pool markets, Tokyo's Nikkei and Sydney's ASX. When these markets operate in isolation during a macro shock, bid-ask spreads widen and the depth of the order book decreases, making prices more susceptible to algorithmic gaps. Japan is particularly exposed. The nation relies almost entirely on seaborne crude, and with the yen trading near 156.4 to the dollar, surging oil prices translate into higher costs for imported energy, which squeezes domestic profit margins. By trapping capital and concentrating volume into just two indices, this holiday schedule delays the regional absorption of United States monetary policy signals, concentrating Asia-Pacific market risk into Tokyo and Sydney for the session. The primary psychological tailwind supporting these open markets is Wall Street's overnight rally, which gained momentum despite sticky inflation and soaring energy costs. But beneath the headline indices, the technology sector exhibited a critical internal divergence. Alphabet jumped 10%, while Meta and Microsoft faced sell-offs despite generating more profit than analysts anticipated. Institutional money is no longer rewarding theoretical expansions in the addressable market for artificial intelligence. Instead, investors are demanding immediate earnings per share accretion. This discounted cash flow formula explains the shift. The Fed holds the risk-free rate at 3.50% to 3.75%, making the R denominator highly restrictive. Meta and Microsoft's long-duration investments are heavily discounted here. Alphabet's immediate free cash flow bypasses this penalty, rapidly expanding its valuation. In this high-rate environment, speculative infrastructure investment is being penalized. The technology sector is bifurcating, and companies are being valued based on immediate cash yield. The math of corporate profitability is also being challenged by the global energy complex, which is driving the imported inflation currently affecting global margins. This satellite image shows the Strait of Hormuz. The formal Navy blockade here has shut in an estimated 9.1 million barrels per day of production. This physical supply constraint caused spot delivery prices to briefly whipsaw past $126 overnight before settling near $110.40. Simultaneously, a structural countershock is occurring. The United Arab Emirates has officially exited the OPEC+ cartel. Free from the cartel's production quotas, the UAE is preparing to unleash up to 5 million barrels per day of capacity onto the global market once maritime shipping normalizes. This chart tracks the Brent crude futures curve. Notice how the spot price spike on the left drops into steep backwardation on the right. Commercial traders are pricing in a significant supply flood for 2027. The energy market is bifurcated. Pricing reflects a war risk premium in the near term, while long-term expectations are being capped by the dissolution of cartel pricing power. This brings us to the final macro paradox, the failure of the precious metals complex to rally. Despite inflation and kinetic conflict, gold plunged to a one-month low overnight, diverging from the assumption that war automatically drives safe haven allocation. The root of this divergence is the leadership transition at the Federal Reserve, from Jerome Powell to Kevin Warsh. Warsh's hawkish mandate and a Federal Open Market Committee, where 4 members now dissent against an easing bias, have forced traders to price out the likelihood of 2026 rate cuts. We track gold's attractiveness using the Fisher equation: real interest rate equals nominal interest rate minus expected inflation. While the Hormuz conflict raises inflation, the Fed's restrictive nominal rates keep the I variable high. This positive real yield creates an opportunity cost for holding gold. The level of real interest rates has overridden the geopolitical risk premium, leading capital away from precious metals, even during wartime. For financial executives and institutional asset managers, these variables dictate how to position for the latter half of 2026. With 4 FOMC members now dissenting against an easing bias and a new chair prioritizing inflation suppression, the risk-free rate has moved to a restrictive floor. Regarding corporate debt, the policy environment suggests it is unwise to rely on floating-rate debt under the assumption of a near-term pivot. Securing long-term fixed-rate financing provides more stability, even at a premium. Second, current spot oil prices suggest margin compression for energy-intensive sectors like logistics and aviation is likely to persist. This creates a necessity to move away from just-in-time supply chains toward larger inventory buffers, particularly for components that must pass through global maritime choke points. In this environment, asset allocation should avoid long-duration, non-yielding investments. Capital is being redirected toward entities with high pricing power and immediate free cash flow that can outpace a 3.75% risk-free rate.